Greetings everyone, welcome to video number 44 in the project management series presented by Process Geekoid. Today's agenda will be going over reviewing the PMBOK process table as well as a preview to the conduct procurement process and focus more on the contract types. As always, please subscribe, like, and comment. So let's move forward. So after having a plan in place for procuring with make and buy decisions already made, the next step in procurement is to execute the procurement management plan with the intent to sign an agreement or contract with an external vendor or third-party supplier to deliver a part of the project. In a nutshell, conduct procurement is the action of procuring or getting services or software after taking in the procurement management plan and make and buy decisions. After the choice to buy from the outside has been made, the Project Management Office team or PMO will conduct a bidder or vendor conference by sending out procurement documents. These include RFB, request for bid, potential prices of what the price for the service will be from the vendor. Then you have request for proposal or RFP, what they propose to offer. Then request for information or RFI is where there could be multiple information packets that can be given to the buyer in exchange before making the choice. So it's just more further clarification of the services offered by the seller. In this process, we also do procurement negotiations to specify contract terms, obtain seller responses from procurement's document resulting in a selected seller, and awarding contracts. So prior to covering the ITTOs for conduct procurements, which will be done in the next video, let us go over the specific types of contracts. So keep in mind that a contract is typically between two parties, a buyer and a seller. As per the PMBOK guide, this is what it's called. So the buyer is who is seeking after the third-party supplier or vendor to provide an outside service not within the organization. In the real world, the company or person who provides services and goods can be called a contractor, subcontractor, supplier, designer, vendor. The PMBOK guide uses only one term, seller, but the exam may use any of these terms to describe the seller. Many companies are a buyer in one procurement and a seller in another. So there are three broad categories of contracts, and these include fixed price contracts, time and material contracts, and cost reimbursable contracts. So fixed price contracts are used for acquiring goods, products, or services with well-defined specifications or requirements. In general, with a fixed price contract, a clearly defined statement of work and competition is set, meaning you're more likely to get a fair and reasonable price. This is one of the most common types of contracts, though it is less likely to be used in something like IT versus in construction. If the costs are more than the agreed upon amount, the seller must bear the additional burden, cost burden, or any cost overruns. As a result, the buyer has least cost risk in fixed price contracts, whereas the seller will take on any cost overruns. So there are various flavors of the fixed price contract. You have a fixed price award fee contract. The buyer pays a fixed price plus an award fee or bonus based on performance. And we can see that right here in this slide. And this is very similar to a fixed price incentive fee contract, where the fixed price award fee contract is where you are leaving out the total possible award amount and is determined in advance and a portion based on performance. For example, in a fixed price award fee contract, the buyer might say there is a maximum of $50,000 award fee available. It will be apportioned or given out at the rate of $5,000 every month, meeting production expectations at a certain amount. This is a type of incentive contract. In many instances, the award paid is judged subjectively. Therefore, procedures must be in place in advance for giving out the award, and a board must be established to help make the decision fairly. The cost to administer the award fee program versus the potential benefits must be weighed in the decision to use this type of contract. For example, a fixed price award fee contract could look like something where you have a contract signed for $1.1 million, where for every month performance is exceeding the plan level by more than 15%, an additional $5,000 is awarded to the seller with a maximum award of $50,000. Keep in mind that the fixed price award fee contract is all in the discretion of the buyer and will pay the seller based on the actual performance that is achieved by the seller. So the buyer will set that award fee and give that award fee or bonus, if you will, or incentive to the seller. Then you have fixed price incentive fee, or FPIF. In a fixed price incentive fee contract, profits or financial incentives can be adjusted based on the seller meeting specified performance criteria, such as getting the work done faster, cheaper, or better. The final price is calculated by a formula based on the relationship of final negotiated cost to the total target costs. A variation on a fixed price incentive fee contract is a fixed price incentive fee successive target contract, in which the target for the incentive is changed after the first target is reached. For example, you might have a contract for $1.1 million for every month early the project is finished. An additional $10,000 is paid to the seller. So the faster you can do it, you get $10,000 more for the seller, so they have an incentive to complete faster. Then you have the last type of fixed price contract, which is fixed price economic adjustment or price adjustment contract, or FPEPA. And this is where if a contract will cover a multi-year period, there may be uncertainties about the future economic area where you might have a deficit or surplus. So future costs of supplies and equipment the seller might be required to provide under contract might not be predictable. In such a case, a buyer might choose a fixed price contract with economic price adjustment. Think economy whenever you see this on the exam, and you should remember this. A similar type of contract is called fixed price with prospective price redetermination. So an example of a fixed price economic price adjustment contract is where you have a contract signed for $1.1 million, but a price increase will be allowed in a year or two based on the U.S. Consumer Price Index report for year one. So basically, based on the change in material costs and market conditions, they will have to increase the price of the actual materials in the project. Hence, it is called a fixed price economic price adjustment contract. The next type is cost reimbursable contracts. And cost reimbursable contracts are used when the exact scope of work is uncertain and therefore costs cannot be estimated accurately enough to effectively use a fixed price contract. This type of contract provides for the buyer to pay the seller allowable and incurred costs due to the extent prescribed in the contract. A cost reimbursable contract requires the seller to have an accounting system that can track costs by the project. In this contract, the buyer has the most cost risk because the total costs are unknown. The seller provides an estimate to the buyer. The buyer can use the estimate for planning and cost management purposes, but it is not binding. What is binding is the buyer's responsibility to compensate the seller for any legitimate costs for work and materials as determined in the contract. Research and development or information technology projects in which the scope is unknown are typical examples of cost reimbursable contracts. So there are various flavors of this cost reimbursable contract. You have a cost contract where the seller receives no fee and it is appropriate for work performed by nonprofit organizations. And then you have cost plus fee or cost plus percentage of cost fee contracts, and these contracts require the buyer to pay for all costs plus the percentage of costs as a fee. This type of cost reimbursable contract is generally not allowed for U.S. federal acquisitions or procurements under federal acquisition law and is bad for buyers everywhere. So That's important to know, is because it is a percentage of cost. So you're paying the cost for the work and the material, so there's no profit. So you'll be losing money. So this one is not as popular. Next type of cost reimbursable contract is cost plus fixed fee. A cost plus fixed fee contract provides for payment to the seller of actual cost plus a negotiated fee, where the seller's profit, usually a percentage of the estimated cost of the project, is fixed before the work actually starts. The fee does not vary with actual costs, thus the seller does not have an incentive to increase or inflate costs. The fee may be adjusted as a result of changes to the procurement state of work. So an example of a cost plus fixed fee contract is where you pay the costs plus a fee of $100,000. Then you have cost plus incentive fee contract, where you have a cost plus incentive fee provides for the seller to be paid for actual costs plus a fee that will be adjusted based on whether the specific performance objectives stated in the contract are met. In this type of contract, an original estimate of the total cost is made and a fee for the work is determined, a target fee. The seller gets a percentage of the savings if the actual costs are less than the target cost, or shares the cost overrun with the buyer. The ratio in this contract, cost plus incentive fee, is usually 80% to the buyer and 20% to the seller. So an example of this could be contract of $500,000, target cost plus $50,000 target fee. The buyer and seller share any cost savings or overruns at 80% to the buyer and 20% to the seller. So those are the various types of contracts. There's one more we'd like to cover, and that is going to be the time and material contract. And in this type of contract, the buyer pays on a per hour or per item basis, and time and material contracts are frequently used for service efforts in which the level of effort cannot be defined when the contract is awarded. So time and material contracts are risky for the buyer and used for staff augmentation. It has elements of a fixed price contract, where there's a fixed price per hour, and a cost reimbursable contract for material costs and the fact that the total cost is unknown. So compared to other types of contracts, time and material contracts typically have terms and conditions that are simpler to allow for quicker negotiation and for work to begin sooner. If you are going to have to pay someone on a contract basis for every hour they worked, no matter how productive they were and no matter what they were doing, would you want to do this for a long period of time? I don't think so. So remember, the seller's profit is built into the rate, so they have no incentive to get the work done quickly or efficiently. For this reason, time and material contracts are best used for work valued at small dollar amounts and lasting a short amount of time. So an example of this, it can be used for IT projects, where you have contract is $100 per hour plus expenses or materials at cost, and that basically is giving some wiggle room in case the project gets completed earlier, or if there are going to be any cost overruns, you would be buffered by it. So that covers all the various types of contracts in this video. In the next video, we'll be going over conduct or perform contract process in the next video. Thank you for watching. Please subscribe, like, and comment.